Hello, everyone, and welcome to Discovery 2024. My name is Steve Rick, and I am the Chief Economist here at TruStage. And for the next 50 minutes or so, I'll be taking you through the economic update or looking into our crystal ball on what we expect to happen in 2025 with respect to the U.S. economy and what impact it may have on credit unions, both our balance sheets, our income statements, looking at loan growth, savings growth. So first of all, I like to just to get a reading on the credit union industry, I like to look at how many credit unions are basically leaving the credit union industry every year, or what I like to call the contraction rate in the number of credit unions, just to see if there's any stress taking place in our industry. Let's go to my first slide, which basically looks at the annual contraction rate in the credit union marketplace. And you can see through 2024 here, we're up to about 3.9% of all credit unions will leave the industry this year, meaning they'll basically merge with another type of credit union. You can see that's elevated from what it was back in 2019 when it was around 2.6% of all credit unions. So just like almost 4% of all credit unions will be gone this year, or basically we've lost so far in the last 12 months, 193 credit unions have merged out of existence. Now, what's taking place? What's causing this? Well, if you want to boil it down to one chart, it's this next chart right here. This is basically the U.S. Fed funds interest rate. This is the interest rate the Federal Reserve controls. It's basically the interest rate that banks lend money to each other overnight. But it's one of basically the most important interest rates in the world. This is the interest rate the Federal Reserve controls in order to basically control the U.S. economy and inflation and the labor market and such. Notice where we're at today compared to where we were a couple of years ago. A couple of years ago, the interest rates were close to zero. You can see on my chart, they're way at the bottom, 0.07% interest rates, basically zero. And then what we've seen is the fastest increase in interest rates in the last 2 years here. So basically starting in March of 2022 to where we're at today, we've pushed interest rates up very quickly. And what's that old saying? The only thing people hate more than the status quo is change. And well, this is massive change, fastest increase in interest rates. So where are we today? We're at around 5.35% today on the Fed funds interest rate. We got here last July. So basically for almost the last year, we've had interest rates at this 5.35 level. Now, there's an old adage in economics which says to fight inflation, the Federal Reserve will raise interest rates until something breaks. So the Federal Reserve raised interest rates really quickly to fight inflation. Well, what broke? Well, if you remember back in 2023, we had some bank failures in this country. We had Silicon Valley Bank fail back in March of 2023. We had Silvergate Bank fail. We had Signature Bank fail, First Republic. So we had all these bank failures. So the Fed said, all right, we probably don't want to raise interest rates anymore. We'll basically keep them at the current level. And that is basically our forecast. If I put on my chart here a little arrow saying, we think the Fed's going to keep interest rates at 5.35, that they're not going to have to raise interest rates any more than the current level. So that's the good news. They're not going to go up anymore. And we do expect them to start lowering interest rates. Inflation is coming down a little bit slower than where we had expected, but it is trending down. So we believe maybe by, the fourth quarter of this year, or maybe as early as September of this year, 2024, we could see the Federal Reserve make their first 25 basis point reduction in the Fed funds interest rate. And then maybe again in December, we could see another 25 basis point reduction. So maybe we could see 50 basis points for 2024, then going into 2025, expect a full percentage point reduction. Where will this all end? What is the Federal Reserve's target for the Fed funds interest rate? Well, when everything's right with the world and unemployment's where it should be, economic growth's where it should be, inflation's at 2%. Basically, they would like to see, as you can see on my purple line on my chart, they would like to see the nominal Fed funds interest rate at around 2.5%, which is my purple line on my chart. Think of that as the Goldilocks level of the Fed funds interest rate. It's not too high, it's not too low, it's just right. Notice we were basically at that, going back on the left side of my chart back in 2018, 2019, we're at about 2.4%. So basically, the Federal Reserve had the Fed funds interest rate right where they wanted. But because of COVID, They had to drop interest rates to zero to stimulate the economy. Then we had the inflation problem, so they raised interest rates above my 2.5% long run target line. So there's our forecast for short-term interest rates. Now, what about the overall economy? Well, my next slide takes a look at the U.S. economic growth rate. Economists always like to see what is the economy growing at? How much more goods and services are we producing each year? Well, first of all, where's my gold line? Where should we be? What's kind of the natural or organic growth rate of the U.S. economy in real terms in production of goods and services? Well, it's right around 2%. The U.S. economy just naturally makes about 2% more goods and services each year. Why is that? Well, about 0.5% of the growth is due to population growth of roughly 0.5%. The other 1.5 percentage points is from productivity growth. So economists do the sophisticated math. We had 0.5% labor force growth with 1.5% productivity growth, and we get the 2% gold line on my chart. Notice last year, 2023, was actually a good year. We were actually growing about 2.5%. Why? Well, we had strong consumer spending. A lot of consumers were still spending that excess savings that they had accumulated during the COVID pandemic when the government mailed out about $3,200 in stimulus checks. We also had some inventory investment. Think about all those new car dealers were building up their parking lot after it got decimated during COVID because we had supply chain disruptions. Remember, we couldn't get those semiconductor computer chips from, say, Taiwan or South Korea. So GM had a problem making some cars. So we really drained down the inventory of new cars, but we rebuilt them last year, which helped the economy grow. We also saw a little pickup in residential investment and government spending. We had that infrastructure bills passed, about $1.2 trillion of money flowing into the economy. What are we going to see this year? Well, notice for this year and next year, a little bit below trend. Notice for 2025, we're only forecasting about 1.8% economic growth, so slightly below trend. Why is that? This is a phrase Jerome Powell, the chairman of the Federal Reserve, likes to use a lot. These are called the long and variable legs of monetary policy. Translation, when you raise interest rates today, it takes about 12 to 18 months to see the effects of those higher interest rates on the real economy. For example, we're seeing it right now in credit unions. The high interest rates are slowing down loan growth at credit unions and banks. Banks have only seen their loan balances grow about 2% over the last year. Normal would be about 6%. So that's one of the variable legs of monetary policy. So we will see the economy slow down to around that 2% gold line, but hopefully there'll be no recession. We're not actually forecasting a recession like those red bars you see on my chart. Those indicate recession years. Now, as an economist, we are paid to figure out, well, what could trigger a recession? And there's basically 5 things us economists are tracking right now that could lead to a recession. Number 1 would just be a big spike in energy prices. Think if there's a war in the Middle East, say, for example, and oil prices went from the $80, $90 today to, say, $160 to $200 for a barrel of oil. Well, that could trigger a recession. So higher energy prices, number 1. Number 2 would be the Federal Reserve keeping those short-term Fed funds interest rates too high for too long, keeping the inverted yield curve. I was just reading the other day that this is the longest that the yield curve has been inverted, basically meaning short-term interest rates above long-term interest rates in basically the history of the United States. It's been over 2 years now, and normally we would see a recession. So we are worried that the Fed keeping interest rates too high for too long, which could trigger an economic slowdown. So that's short-term interest rates. Number 3 on our top 5 list of what could trigger a recession would be higher long-term interest rates. Say, for example, the 10-year Treasury bond. Right now, we're running close to about a $2 trillion deficit in this country. Well, what if the buyers of those bonds start to pull back? Foreigners, banks, insurance companies, whatever. What if our appetite for U.S. Treasury bonds begins to wane? Those interest rates will then begin to rise, and that could slow down the housing market, business investment spending, and could trigger a recession. So that's number 3 on our list. What about number 4? Well, what if we saw a drop in the price of homes, stock price drop, or even commercial real estate property prices really drop? That would create what's called a negative wealth effect in this country, where you and me become less wealthy, and that curtails our spending. So we're looking at prices of these assets. Once again, real estate, stocks, in commercial real estate prices. And then number 5 on our list are more bank failures. Similar to what we had back in 2008, 2009, when we had the Great Recession, we had close to 400 banks failing within a couple of years there. So if we had more bank failures, that could lead to another recession. So those are the top 5 things. And right now, we are not forecasting a recession. As you see by my bars for the next couple of years, all the way out to 2026, we're not forecasting, but we are keeping an eye on those 5 variables I just listed. Moving on, what about the labor market? How's the labor market doing? Well, it's still very strong right now. As you can see on my chart, unemployment rate is currently at about 4.1%. Is that good? Is that bad? Is that high or is that low? Well, it's low, very low, signifying a tight labor market. Why can I say that? Well, notice the gold line on my chart. Economists should always have gold lines on their charts. That kind of indicates where the economy should be, where it wants to be, or as an economist, I have to use the word in equilibrium, where say the labor demand is equal to labor supply. Kind of everything is right with the world. You can see we're below that gold line today. That signifies a tight labor market. So right now the demand for labor is greater than the supply of labor out there. That's why wages are rising, things like that. All right, with this very low unemployment rate, and you can see the history of the unemployment rate going back all the way to 1995 here. How does this impact your credit union? Well, one way, let me add a line to this chart, is with this blue line, which is the credit union loan delinquency rate. And you can see right now the loan delinquency rate is delinquent loans divided by loans is around 0.84. All right, and you can see it's been trending up the last couple of years. Now, is this something we really need to worry about? Well, let me put in a purple line here, what I like to call the natural delinquency rate, kind of where the delinquency rate would go when everything's right with the world, when the economy is running nice and the labor market is good and inflation is good. Notice that's around 0.75. So we are slightly elevated compared to the normal 0.75. And there is some seasonality to this. It moves up and down during the year, but it is slightly above where we would like it to see at 0.75. So on this chart, we have basically the unemployment rate, but it's in quarterly here, so it looks a little bit different. It's quarterly data. And to that, let me add on the credit union net charge-off rate. And basically, you can see it's around 0.8 right now. I'll put that into English. For every $100 in loans, 80 cents are being charged off by credit unions. So it is elevated. What's the long run natural charge-off rate for credit unions? Well, let me pop it up on the screen. Once again, economists should have gold lines on their chart. 0.5 is the natural charge-off rate. So you can see we are elevated compared to that. You have to go all the way back to, say, roughly 2012 to see the charge-off rate this high. So there is stress out there, especially amongst low-income Americans because of the high inflation we've had in the last couple of years, plus higher interest rates has pushed up home equity rates, adjustable rate credit cards, adjustable rate mortgage rates. As all of these loans are repricing now and the cost to service that debt is rising, some Americans are having some stress, and we are seeing it pop up here in this elevated loan net charge-off rate here. All right, moving on to another way to actually measure the labor market. This is what we call the job openings rate. Right now, you can see on my chart, it's around 4.9% in the basically financial sector, which is banks, credit unions, insurance companies, say here at TruStage. 4.9% of all jobs are sitting open at banks and credit unions today. What would be normal? You're always going to have some job openings. You see my goal line again? 3.5% is the long run average. So we have more job openings at credit unions and banks than we typically see. That also signifies a tight labor market, or the demand for labor is greater than the supply of labor. Well, basic economics says when the demand is greater than supply, prices will rise. And then when we say prices, we're talking about wages, which brings me to my next chart. This is a look at average hourly earnings and basically how much are people getting in a raise each year. And you can see right now the latest number says the average American got about a 3.9% raise over the last year. Now, that's been coming down from we hit close to 6% a few years ago when wages were really high. We had a tight labor market. A lot of people pulled themselves out of the labor market due to COVID, but we're still rising at 3.9%. And we say that is elevated. That's higher than normal. Why can I say that? Notice where my gold line is. This is kind of a target that the Federal Reserve uses. They would like to see wages rising at about 3.5%, a little bit less than we're currently running at 3.9. Where'd they get the 3.5? We basically, give people cost of living adjustment of about 2% for inflation, because inflation is normally 2%, not right now, but normally it is. And then basically give them a little bump for productivity. The average worker in this country is about 1.5% more productive. So think of the loan officer at your credit union maybe can process 1.5% more loans per hour than they could 1 year ago. So you add 2 plus 1.5, you do the math, that's 3.5% raise on average. But we're running at about 3.9%, which is a little bit elevated according to the Federal Reserve would like to see. Now, the Federal Reserve is concerned about this tight labor market because they believe that's feeding into inflation. And it's called a wage price spiral, where when wages go up, the firm has to raise the price of what they're selling in order to maintain their profit margin. Well, is that true? When wages go up, do we see prices go up? Well, let me add an inflation line to this chart. Notice I've added a red line now, which is core inflation. The word core just means we're excluding food and energy, because as we know, nobody buys food or buys gasoline. But basically, the Federal Reserve excludes that to get a better reading of the underlying price pressures in the United States. And notice in the last couple of years how the green and the red line track each other very closely. The good news is core inflation, we're using the CPI, is down to around 3.4%. I want to highlight here, the Federal Reserve's target for inflation is 2%. This is 3.4, so it's still a little bit elevated. Another thing I want to highlight here, if you go back the last couple of years, especially in 2022, notice how the red line was above the green, meaning inflation was running hotter than people's wages, which means we had falling real wages. Translation, the average American couldn't buy the same amount of milk, bread, and eggs, say, than they could the year earlier. So what do you do if you can't keep buying the same amount of milk, bread, and eggs with your current income, your wage growth? Well, you draw down your savings. Once you've drawn down all your savings, what do? You start borrowing more debt. And so we've seen a big increase in credit card growth amongst banks and credit unions, as a lot of Americans had to rely on that credit card to keep up the purchasing power. The good news is, if you look at the very tip of to the far right, now the green line, people's raise, is growing faster than inflation. And so now real wages are rising once again, which is really good news, which is helping a lot of Americans that, inflation's still elevated, but their wages are growing faster than that. So what are some of the takeaways of the labor market and how it's impacting your credit union? Well, we still have a labor shortage in the United States today with demand greater than supply for labor. That's leading to bargaining power has shifted towards employees. They can demand a little better working conditions, higher wages, better benefits, so on and so forth. Number 3 on my list, we saw a big increase in labor turnover, churning, people quitting jobs, moving to other positions. Number 4, increase in labor wages and just overall training budgets. I'm sure a lot of your credit unions had to hire new tellers, you train them up, and then they may quit on you, go find some job else. So our labor wages and training costs really went up in the last couple of years. Number 5, lower labor productivity. When you bring on a brand new teller, say, well, their productivity is not going to be as good as that old veteran teller who could answer any question in 3 seconds. This new teller may take a little bit longer, and so people may have a little bit less satisfaction with the credit union, which is my number 6 on my list, falling member satisfaction. A lot of credit unions, of course, do membership surveys asking, hey, how's the credit union doing? Well, if they have to wait on a phone call for 10 minutes to talk to somebody because of lower labor productivity, they may not be as satisfied with the credit union. Let's move on to the hot topic in economics the last couple of years, and that has to do with inflation. Take a look at this chart. The blue line we hit basically 2 years ago in the summer of 2022, we hit 9% inflation. Now, this is the highest inflation we've had in 40 years. Now, you have to go back to the early 1980s, late 1970s to see inflation around 9%. The good news is we've dropped significantly. We're about 3.3% here using the consumer price index. And I've got my goal line on there at about 2.5%. It's at 2.5, which is higher than I said earlier that the Fed's target is 2%, because the CPI runs a little bit hotter than the other measure of inflation the Fed likes to use, the core PCE measure. But notice for the last year how that blue line has kind of been bouncing around the mid threes and not been going lower. So that's why some economists have said, well, maybe the Fed should raise rates even more to cool the economy down, to get that blue down to the gold. That's basically the goal here. But most economists say, no, we don't have to raise interest rates anymore. We just have to keep the interest rates elevated for a longer period of time. Remember, I said maybe September or December this year before we start to lower them. All right, basically, so when the Federal Reserve actually meets every 6 weeks at the Federal Open Market Committee, when they actually look at these economic charts and decide, well, what do we do with interest rates? You see this box that just popped up in the middle of the screen. This formula talks about the real interest rate is just equal to the nominal rate minus the inflation. Well, let's plug in the current variables. Right now, the nominal interest rate on the Fed funds rate, as we saw earlier, is 5.35%. If you subtract out the 3.3 inflation, as you see on the blue chart, that gives us a real interest rate today in the United States, adjusted for inflation, that's what the word real means, is around 2.05. Now, you should say, is that high? Is that low? That 2% in real interest rate? That's a little bit high. Most economists believe the neutral real interest rate is around 0.5. So if we're at 2.05, that means, we're 1.5 percentage points higher than the neutral, and that's showing how tight the monetary policy is to restrict the economy. Now, as the inflation falls, instead of maybe 3.3, let's say we get down to 2.3, you plug 2.3 into this little equation, that means the real interest rate will go up to, say, 3%. Now, the Federal Reserve doesn't want real interest rates to get close to 3%. History has shown when real interest rates get close to 3.5%, that can trigger a recession. So if the inflation on the right starts to fall, the Fed's going to have to start lowering that middle term there, that nominal interest rate. They're going to have to start dropping the nominal Fed funds rate in order to keep the real interest rate from rising into the 3% range. Just to kind of show you when the Federal Reserve meets every 6 weeks, the red line I've just added to my chart is the core PCE measure of inflation. PCE stands for personal consumption expenditure. This is the Fed's preferred measure of inflation. You can see where that is right now. It's around 2.6% and falling closer to my new goal line I've just added of 2%. So notice the Fed wants to get the red line down to the gold line. We're getting close. That's why in the next couple of months, the Fed will start lowering the Fed funds interest rate. All right, so what are some of the takeaways of how inflation is impacting your credit union? Well, number one, all this inflation last couple of years has increased the household financial stress. Remember, for a while there, inflation was higher than people's nominal wage growth and it putting some stress on some families. Number two on my list, that has pushed up the loan delinquency and charge-off rate at credit unions. So we are seeing the effects of monetary policy on credit unions with these higher loan delinquency rates. Number three, whenever inflation goes up, the old rule of thumb in economics, interest rates will also go up because the Federal Reserve will raise interest rates to bring inflation down. Number four, labor costs are going up. Well, if you got high inflation, you give your workers a cost of living adjustment that's also higher, and that's going to push up your overall number five on my list, operating expenses. So credit unions have seen a big jump in their operating expenses. I was just looking at the first quarter data for credit unions, and a lot of credit unions had pretty low earnings in the first quarter as this higher inflation, and a lot of our vendors are repricing and we're getting new purchase agreements with our vendors, and they've really jumped in some of the prices. So operating expenses are way up, going up faster than some of our increase in our net interest margins, and that's really brought down credit union earnings this year. And then number six on my list, since inflation is pervasive, meaning it affects everybody, we all go to the grocery store and have to spend, $400 for 4 bags of groceries. That does bring down consumer confidence. And so a lot of, if you survey, I was just watching a survey the other day, and they said about more than 50% of Americans actually think we're in a recession right now, which, as we saw earlier, we're not in a recession. The economy is actually doing pretty well. But just because of high inflation has reduced consumer confidence and the thought of, we're actually in a recession, which we are not. Moving on to, of course, the big topic that's been impacting credit unions the last couple of years, and that has to do with interest rates. Take a look at this chart. This is looking at a Treasury yield curve. I've got two yield curves here on two different time periods. The blue one goes all the way back to March of 2022. Why did I pick March of 2022? that was the month the Federal Reserve started to raise interest rates. And I wanted to compare that to today, or I'm using June of 2024, which is the red yield curve. If you look at the horizontal axis, it has years to maturity. So let's just say you're the chief financial officer of your credit union. You can buy a 1-year treasury bond, a 5-year, a 10-year treasury, all the way up to 30-year treasury bond on the bottom there. On the vertical axis there, it has the yield to maturity, or basically what's the interest rate on these bonds. 1%, 2%, 3%. Well, let's take a look at the blue curve. The blue curve is what we call a normal yield curve. Most econ textbooks will say interest rates are supposed to look like this, where short-term interest rates on the left are lower than long-term interest rates on the right. Well, this is also a very handy tool to illustrate how credit unions actually make money. We do something called the carry trade. What's the carry trade? Well, basically, we borrow short term. Think about issuing a 1-year CD to your members. Maybe you get $10,000 in the CD. We borrow a short term, and then we lend that money long term. Think about originating, say, a 5-year car loan or a 30-year mortgage. So we borrow a short term, lend long term. That is what we call the carry trade. Now, if the yield curve is shaped like the blue one, that allows us to buy low, sell high. That's number one rule in finance, right? If you're in, say, real estate, you want to buy a house low, sell high. If you're in stocks, you want to buy the stock at a low price, sell at a high price. But we're in money. Think about a credit union. We are basically a money trader. That's what we do. We buy low and we sell high, and we live off the spread between those two. All right, this is what it was back 2 years ago in March of 2022. What do we have today? Notice we have the red curve today, which is an inverted yield curve. Inverted just means short-term interest rates on the left are higher than long-term interest rates on the right. Notice how the curve slopes down. Well, this normally would signal an upcoming recession. Basically, every recession since World War II has been preceded by an inverted yield curve where short-term rates are higher than long-term rates. Now, you should ask, well, why would that cause a recession? Just because short-term rates are higher than long-term rates, why do millions of people have to lose their jobs? Why do we have firms going bankrupt? And why do we go into recession? Well, because of this. As you see, I put a bullet point up there because this is bad for banks and credit unions. Think about a bank and a credit union. We're the heart of the economy. I like to use the analogy that banks and credit unions are to the economy what the heart is to your body. The heart keeps the blood flowing. Well, credit unions and banks keep the money flowing. And if we have problems, the body or the economy has problems. Well, why is it bad for us? Well, 3 reasons that have just popped up in the red box there. 1, the carry trade starts to break down. Remember, we want to buy low, sell high. Well, basically, we're paying a lot more for our deposits today. So our net interest margins are being squeezed. Our earnings are dropping. So basically, just the profitability of being a credit union or a bank has been squeezed in the last couple of years. Number 2 on my list is liquidity risk. What I mean by that, the deposit growth has been extremely weak. We're not getting those deposits coming in at many credit unions, which means we can't keep making loans, which brings me to my 3rd point of my bullet point there called credit contraction. If we don't get the deposits, we can't make the loans, so lending starts to slow down. And our economy is based on credit. When I go and buy a new car, I go to your credit union, I take out an automobile loan. If I want to buy a house, I get a first mortgage at your credit union. Well, basically, if we don't get the deposits, we can't keep making the loans. So credit contraction comes in. Remember, I mentioned earlier, banks would normally be growing their loan portfolios by about 6% year over year. Right now, it's only growing 2%. That is one of those long and variable legs of monetary policy where we are seeing a slowdown. Now, the Fed can't keep this inversion forever, and basically they're going to have to start lowering that left side of my red yield curve there, and we do expect it to start to drop later this year. All right, and just to throw in some numbers there, you can see what the 6-month Treasury is, over 5%, all the way to the 10-year around 4.2%, but just to give you some numbers of how this. The big question is, how did we go from the blue to the red in basically a 2-year time frame? Well, basically, the Federal Reserve short-term rate policy, the Federal Reserve just raised the Fed funds interest rate in order to bring down inflation. Also, the Federal Reserve raised long-term interest rates by doing a little something called QT, which stands for quantitative tightening. What is that? The Fed was just decreasing the size of their balance sheet. Basically, up until recently, the Fed was reducing the size of their balance sheet by around $95 billion per month. As their investments were maturing, they weren't reinvesting those maturing investments into new treasury bonds or mortgage-backed securities. And the Federal Reserve is a magical creature. When the Federal Reserve stops buying or reinvesting those maturing investments, it's like the money supply going poof. It just evaporates from thin air. And basically, our money supply for the last year and a half has been shrinking. Just to show you the chart on that, this is probably the most important chart we'll look at today. Here it is. Here's our money supply chart. We call it money supply in this country about M2. Well, what is a money? What do we actually define it as? Well, notice I've got the little blue box there that defines money. It's currency and circulation. Think about all those dollar bills you have in your wallet, plus your checking deposits, savings deposits, money market accounts, CDs, certificate of deposits, and of course, money market mutual funds. If you add in all those accounts for all Americans, that is what we call M2. Well, basically, notice I've highlighted those four middle ones, checking, savings, money market, CDs. Those are credit union and bank deposits. So when you hear an economist say, our money supply was shrinking the last couple of years, you can really say our deposits were shrinking at banks and credit unions because the four middle ones are us. It's our deposits. Well, just to kind of show you, normally we have our money supply growing at about 5.4% a year. That's my gold line. Remember I said economists should have gold lines on the charts. Why about a 5% increase? Well, if we're making 2% more stuff each year and inflation is normally 2%, you kind of want to have the money supply growing roughly 4%, but then people just want to hold more cash as we get more people and they have more wealth. And so another, say 1.4% for more cash holdings. So if you do all that math, we get about 5.4% is what our money supply normally grows at. But if you have a recessions, which are highlighted by those pink bars, notice the recession of 2001. The Fed increased the money supply by double the normal 5%, went up to about 10.4%. So the Fed increases the money supply, pushes down interest rates, people borrow more for cars and homes, and boom, the economy's out of recession. That's how monetary policy works. Notice the Great Recession of 08-09. By January 2009, the Fed had increased the money supply by 10%. Once again, increased supply of money, push down interest rates, people borrow more, boom, you're out of recession. But notice the COVID recession in 2020. The Federal Reserve had increased the money supply by February 2021 by 27%. That was the fastest increase in money supply in U.S. history. Now, you may have heard of a famous economist called Milton Friedman. He had the famous quote where inflation is everywhere and always a monetary phenomenon. Translation, if you increase the money supply today, you're going to get inflation tomorrow. Remember, we had a money supply growing 27% in 2021. By 2022, June, our inflation hit 9% at the peak. So it took about a little over a year and 3 months or so to actually see inflation rear its head. But notice where we're at today. Basically, for the last about year and a half, the blue was in the negative territory. We're shrinking the money supply about 4 or 5% year over year. It's basically just started to go back into the positive territory. So the worst is behind us with the contraction of money supply or deposit. But we're just barely positive today, 0.7%. So the money supply is growing again, but just barely. So what's happening basically at credit unions? Take a look at this chart. I'm just looking at credit union data now. This is looking at what I call money accounts at credit unions. And I put a little box in the middle there saying, what do I mean by money accounts? Those are all your checking accounts, all your savings accounts, and all your money market deposit accounts. And you can see the annualized growth rate, how it fluctuates through time. The gold line on my chart is the Fed funds interest rate. So there's your Federal Reserve. Hey, does the Federal Reserve actually have any influence over credit unions? Yeah, take a look at, with the gold line going up, the increase in the Fed funds rate, look at the huge drop in our money market account annualized growth rate. For a while there, we were falling more than 10% as people were taking money out of their savings and money market accounts, maybe moving into CDs inside the credit union or transferring it out of the credit union to a money market mutual fund, paying a higher rate. But look at that green area. Even today, the latest numbers out, I believe this is through April, we were still dropping at a 6.5% annualized pace. So big negative green area. We're losing these cheap core stable deposits that we like to have. Big drop, some of the biggest drop we've ever seen at credit unions due to that big increase in the Fed funds interest rate. Where's the money going? We'll take a look at this chart. This is credit union share certificate growth, or our CDs. Look at for a while there, our CDs were growing close to 75% annualized growth rate back in the last year or so. We're still to this day growing at about 35%. So people are still transferring money into credit union CDs. Either they're bringing new money into the credit union, or they're just transferring money from their money markets or a savings account. But it's still growing. And this is expensive money. We're paying 4 or 5% interest on this CDs. So it's really pushing up our cost of funds. This chart actually kind of answers the question, do we still have excess savings at credit unions? So what I did is I looked at the credit union savings per member. If I was a typical member of your credit union, how much do I have deposited with you in my checking, savings, money market, CDs? Notice that basically in December 2019, I had about $10,900. It hit a high water mark of close to over $14,000 when the government was mailing out those $3,200 stimulus checks. And then notice it started to fall as people were draining down some of their savings. You can see where it's at today at roughly, 13,800 or so. But if you look at this chart, it looks like that purple area still seems elevated. It still seems like Americans have excess savings to spend. Well, I would disagree with that. Notice the blue line on my chart. Economists like to look at real savings balances, or savings adjusted for inflation, because we know prices cost a lot more today. So if you adjust for the price effect, go back to say in April 2021, people had about 15,700 in real terms when prices were lower. So think about, what can I buy? What's the quantity of things I can buy? It actually reached its peak in April of 2021 when I had a lot of savings and prices were a lot lower. Notice in basically December 2019, it was around 13,000. So notice the blue line from before COVID, December 2019, to where we're at today. It's really not much different. So what an average American has in savings, what is the purchasing power of that savings? Meaning how many units or the quantity of things they can buy, hasn't really changed much. If you notice in those 5 years prior to COVID, the average American, that blue line, was basically growing a little bit less than 1% a year. So they're increasing their purchasing power of their savings balances by about 0.65%. If you extend that gold line to today, basically we're at where we would have been if we never had COVID. Basically, what people have in their savings account at credit unions, in their purchasing power, is right where it would have been. And so I'd say the worst of the drawdown in savings is over, and people are going to start saving again in the future. All right, so basically, let's take a look at what we expect for credit unions then for the next year. Take a look at a credit union balance sheet here. On the left, we have assets. On the right, we have liabilities and capital. Remember that old accounting identity we all learned in accounting class, that assets must equal liabilities and capital. So on the left side, and assets must equal what's going to come on the right side. Let's first talk about deposits. This is the big liquidity risk we're all talking about. Checking, savings, money markets, those first three core deposits. We saw we're kind of losing deposits there. And then CDs, the last one. What do we forecast for credit union savings growth? Well, notice last year we had the weakest credit union savings growth in history. It only grew by 1.6%, the box for 2023. The bar for 2024, this year we're forecasting 3%. And the reason we're getting that 3% growth, a lot of it is just due to the self-funding of credit unions, that we're just paying higher interest on the accounts, which is making the accounts grow. But it's going to be another weak year of 3%. Notice my line kind of shows the long run average of about 6.6% is the long run growth rate. And you always want to keep your credit union growing. You want to keep getting bigger and bigger. And at 6.6 is the long run average. Next year for 2025, it's going to be better, but still below long-term trend. About a 5% growth in savings next year, still below that 6.6%. What about borrowings? Another way we can fund ourselves, another source of money, is with borrowings, either calling up the Federal Home Loan Bank, the corporate line of credit, Fed funds purchased. And we used to have that bank term funding program. It has not, this is borrowing from the Federal Reserve that was created right after Silicon Valley Bank failed. That window is now shut down, but a lot of credit unions did borrow from it before. What's been taking place with borrowings at credit unions? Take a look at this chart. Talk about a shocking chart. Credit union borrowing growth rate. So this is an annualized pace. Look around 2022, 2023. We were growing at about 160% growth in borrowings at credit unions because we weren't getting the deposits in, so we were relying more on borrowings to keep growing our balance sheet. Notice recently, though, in 2024, we're kind of getting down to zero. So it seems like the worst is behind us when it comes to deposit growth. Deposits are starting to grow again, and credit unions are relying less on borrowings. Moving on, what about equity? This is kind of your undivided earnings, your regular reserves, those first two ones we call net worth. And if you add that third one in, those gains or losses on the available for sale securities, basically what's been taking place with that gold one? What kind of losses have we seen in our investment portfolio because of the increase in interest rates? Remember that old rule, when interest rates go up, the price of our bonds go down? Well, how much have we seen the price of our bonds drop? Take a look at this chart. This is the accumulated unrealized losses on available for sale securities. And you can see those last three bars. These is a percent of assets. So for a while there in 2022, when the Fed started raising interest rates, we lost about 1.8% of the value of our assets just because of the losses on our investment portfolio. And basically, even through 2024 here, it's still down about 1.4%. So some big drops as, once again, as interest rates go up, the price of our mortgage-backed securities and treasury bonds fell during this time period. Moving overall to our overall equity, that green box on the bottom right there. Equity is those three items added together: undivided earnings, regular reserves, and gains and losses. But if you'll notice, what if we looked at the equity as a percent of assets? That's this chart here. Notice the equity to asset ratio has dropped very large decrease in the last couple of years. Why? Well, notice back in 2019 to 2020 when COVID was first happening, it was the denominator effect. We saw an increase in the assets, the denominator, because the government was mailing out stimulus checks. Remember, they mailed out about $3,200. So it was because the denominator got really big, which brought down this ratio. That was the Treasury kind of sending out stimulus checks. But then we had the Federal Reserve basically raising interest rates, which reduced the value of our bonds, which reduced our equity. So we saw a decrease in the numerator. Remember that old joke, there's a fine line that separates numerators from denominators? Well, now we saw the numerator dropping. The good news is in 2024, through the first quarter, we saw a little bit of pickup to 9%. But I just want to highlight that 8.7% we saw in the equity to asset ratio in 2023 was the lowest in credit union history. So it really took a hit, both the Treasury Department and the Fed, bringing our equity asset ratio down to the lowest point in history. All right, switching over to the asset side of the balance sheet, what do we do with all this money we raise in deposits, borrowings, or equity? Well, we put some in cash or reserve at the Federal Reserve. Some is invested in your land, building, equipment. But of course, the bigger one is going to be investments and loans. And investments, you got less than 1 year maturity investments, 1 to 3 maturity, greater than 3 year maturity. What really got Silicon Valley Bank in problems is that their investment portfolio was heavily weighted to those greater than 3 year maturity investments. And that's what hit them. Well, what I want to do now is take a look at cash and investments, add those two boxes together as a percent of assets. Basically, take a look at this chart. Here it is, cash plus investments as a percent of all assets. Notice in about 2021, we hit close to very high, 36%. Normal would be 32%, my goal line. Where are we today? We're about 25%. We saw a little bit of pickup recently because of, in February, March, we have tax refunds and bonuses paid up. But basically, we're draining down the gasoline in the tank, meaning it's getting harder and harder to lend because we don't have a lot of investments that we can use to turn into loans. So we really drained down. You can see this is one of the lowest we've been in liquidity, if you will, cash and investments, basically since the year 2000. And the last one, of course, is loans. We are credit unions. It's right in our name, credit union. Credit means to make loans. We got loans like commercial loans, automobile loans, home loans, credit card loans. What's our forecast for lending for 2025? Well, here it is. Here's the chart. First of all, where's my gold line? Remember I said economists should have these gold lines on the chart. 7% is normal. We normally increase the size of our loan 7%, which is pretty close to deposit growth at 6.6. Last year, we grew about 6.5%, which is pretty close to normal. This year, we're only forecasting 4%. All right, next year, 5%. But both of these years are going to be below the gold long run line on my chart. Why is that? Well, one, higher interest rates. The Federal Reserve's pushed interest rates up, so interest rates on our car loans, mortgage loans are higher, so we're not lending as much. So think of the demand side for loans. Credit, our members, they just don't want to borrow at these higher interest rates. That's one of the long and variable legs of monetary policy. But another is the supply side. Take a look at this chart. This is the credit union's loan to asset ratio, which is just the opposite of that investment to asset ratio. Notice how high this is. You can see it's dropped a little bit recently. Once again, that's due to the beginning of the year. You see a little seasonality here where people, like I said, assets grow a little bit faster, the denominator of this ratio, because of tax refunds and bonuses coming in. But we're at a pretty high level of loan to asset ratio, meaning a lot of credit unions are already loaned out and won't be able to lend more. And these are averages. There's a lot of credit unions way over these numbers here of around 70, 71%. So on the supply side, we're seeing some credit unions pull back on their lending. And on the demand side, because of high rates, they don't want to borrow as much. So if you put this all together, here is a credit union. And you may say, wait a minute, Steve, your left side is a little bit longer than your right side. I thought you said assets were supposed to equal liabilities and capital as the number one accounting identity, but I did leave something off. Let me put it in way at the bottom left there. I put in a little purple box called the allowance for loan loss. Now, this is your estimate of bad loans, that loans that aren't going to be repaid. Well, let's take a look at what percent of allowance, what percent of all of our loans do we estimate aren't going to be paid back? Or think of the allowance to loan ratio. That's this chart here. This is kind of an interesting chart, which would happen recently. This is the allowance for loan losses. This is your rainy day fund to cover all those bad loans as a percent of loans. Notice prior, to COVID, we were around, for every $100 in loans, say, we had in the allowance account 80, 90 cents. We had COVID hit in 2020, so we boosted it up to a little over $1. Notice we had CECL, our current expected credit loss model, has been put into place back in 2023. And notice how we've jumped it up. So to put it into English, for every $100 in loans, we think about $1.27, $1.30 should be going to allowance for loan loss as expected losses. So we can see how CECL has changed how much we have in the allowance account as a percent of our loans. So how does a credit union operate? Well, here it's this picture right here. The green line I have in the top right, the green line in the bottom left. Remember I said a credit union is basically analogous to your heart. Just like blood flows into your heart, gets reoxygenated, and then flows out of your heart, money flows into your credit union deposits and then flows out of your credit union in the form of loans. Now, we need these arrows to keep coming in this fashion, because there's an old Latin phrase I've just popped up on the left side of the screen called non progredi est regredi, which is Latin for to not go forward is to go backward. Or if you're not growing, you're dying. Remember I said we saw 3.9% of all credit unions will leave the industry this year, or right now we're at about 193 fewer credit unions than we had about a year ago. Because a lot of these credit unions are not seeing these green lines. They're not seeing deposits coming in, so they're not making loans. They actually had the loans reversed, where deposits were leaving and loans were shrinking. They were losing members, and that's why they're basically throwing in the towel and say we have to merge with another credit union. All right, so what is our overall summary for 2025? Quick little update here. Basically, we're going to see below trend economic growth in 2025. Normal would be 2%. We're forecasting 1.8. So, hey, that's pretty good. Number two, falling inflation rate during the next 2 years. We got inflation still hovering a little over 3%, 2.6, would depend on your measure, but we will get down to that 2% target. Number three, unemployment rate will be rising from the current 4.1% up to 4.5% sometime in 2025. And remember, that's the natural rate. We want to be at 4.5. That's when the labor market is in equilibrium. Number four, short-term interest rates will be above long-term interest rates in 2025. Translation, we will still have an inverted yield curve going into 2025, which would be by far the longest inversion we'll ever see. And basically, the Federal Reserve is going to have to start lowering interest rates because it is putting some financial strain on banks and credit unions. Number five, credit union loan growth would be below trend next year. We're only forecasting 5%. Number 7% would be normal, so a little bit weaker. And then the last one, we could see some really good news in mortgage originations rising, say, 15% next year as interest rates fall 1 percentage point from roughly, 7% on mortgages today, get them down to 6% or maybe into the high fives, which would really help the mortgage market and the housing market. All right, that's a summary for 2025 in our economic update. Thank you for joining us here at the Discovery 2024.